The biggest winner in the Dow this week was Disney. Of course, this all goes back to the big AT&T ruling on Tuesday, but it's surprising that Disney would end up being nearly up 5% for the week anyway. GE was the biggest loser, shutting another 4%. Over in the S&P, Discovery, the big winner, H&R Block, the big loser. Mike, so just first on today's session, is this trade related? Is it just weakness? Does it have anything to do with the Fed?
I don't think you can separate out the trade headlines entirely, but the market was definitely at a point where it just made sense it was going to pause. The S&P all week has been kind of mostly going sideways as it gets up to these levels it hasn't seen since early March. But I think the trade stuff really repeatedly has mostly been an excuse to back off a little bit as opposed to a game changer. We've been living with this threat or reality of tariffs and back and forth for 4 months now. So I think it's more about, the market's come up 7.5% in 10 weeks. Probably makes sense for it to kind of sit a few out.
Are we up that much now?
Yeah, I mean, since early April.
Because effectively
and you're about 3% from the highs in January.
Bunch.
That being said, there's a little bit of a perceived lid on where we got up to in March. So we have to see if we kind of muster up a little bit more buying power before we
The longer this goes on, Evan, the more it feels like one of those years, like they often say, where great year for Wall Street, not necessarily a great year for Main Street, I'm sorry, because the job stuff has been so good, the economy has been so good, but not necessarily great for the stock market.
Yeah, I think that's going to turn out to be the case. I think the past week was significant, but in a symbolic way, not in terms of what was going on in the stock market. I think this past week we've had the passing of the baton from the 10 years in which central banks were the key issue to what I think is going to be the next 25 years or so, which is going to be all about the U.S. economy, the Chinese.
Years? You don't think the Fed's going to have to get back involved in bailing out the economy?
I just think the story, which for the past 10 years has been about not just about the Fed, but about the ECB and the Bank of Japan. I think the story is going to move to global economy. How does U.S. and China get along, and what are the implications of that for the world economy going forward? I think the past week is basically symbolic of that. That's why, there were these brief blips over the ECB and the BOJ, but basically you didn't probably talk about it very much on the show over the past few days.
No.
It's all going to be about this trade war. Will it be a trade war, or will it not be?
It's kind of like we're a toddler right now, just trying to walk on so without the support from the central banks, right?
I think you had a paradigm for the last 10 years of investing, and that paradigm was, as long as money is cheap, you go ahead, buy those high growth stocks. They provide growth. Rates are low, so buy Amazon, buy the tech stocks, buy Google, buy whatever, and that has been a great trade for you. And now we're shifting into a different world in which
you're calling the top on Fang.
I'm not calling the top on anything. I wish I could call the top on it. No, I'm not calling the top. But I'm just saying that when we look back, we're going to go, okay, now we're moving into a different era.
Chris, what do you think?
Well, I think the market's pretty blasé about the trade war situation. It could become contagious. We've seen this happen before, and the comments really don't help. I mean, Canada doesn't have a huge deficit with the U.S.,
right,
and yet the talk about it is a pretty strong talk. And the new tariffs on China, I think, could well be the start of a back and forth. And I think that isn't really necessarily healthy for a lot of stocks, particularly the old franchise growth stocks. I mean, I think the Coca-Colas and Procter & Gamble's of the world, they may be stressed in here as we move forward.
So you're staying away from those kind of consumer staples, high dividend payers, slow grow kind of names.
Right. Staying away certainly from the consumer staples. I mean, everything that really worked in the 70s, 80s, 90s, I think is a little shaky right now. But the high dividend payers, I mean, I think that actually there's a real opportunity with the AT&Ts. You could look at a Seagate. There's so many different dividend payers, but they're a whole different breed than the old franchise growth companies.
And where does that leave you on the tech giants on those platforms?
I think the tech giants are basically, everybody loves them. At some point, I wouldn't do it right now, but the Googles and the Facebooks and whatever will run into a buzzsaw. But for now, you're just taking a big chance if you're trying to short them.
Yeah, no, you certainly are. I think we're going to be doing all the $1 trillion.
And by the way, if you saw where the pain was really meted out today, it was Boeing, it was Caterpillar.
Yep.
This idea that, big expensive stuff that we would love to sell a lot of outside the country.
Right.
Whether it's correct or not, and the stocks are up a lot over the past couple of years.
But they're still getting hit hardest.
That's where the anxiety is showing.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.